European markets not doing very well today, but the all-share index very much in positive territory with industrials leading the charge at the moment. Now, despite the US dollar being at a 13-month low, the rand has been a little bit on the back foot. At the New York close on Friday, it was around 12.90, but now it's trading around the 12.95 level, so it's lost a little bit of ground. And then we do see that there's a little bit of risk aversion, so that has been positive for the gold price. It's inched up very slightly on the back of that, and then the oil price is losing a little bit of steam. That's just ahead of the OPEC and non-OPEC meeting that's taking place in Russia today. Let's take a look at the indicators. Well, I'm joined by Gary Booysen. He's from Rand Swiss. Thanks for joining us, sir, as always.
Yeah, good to be here.
Good stuff. Now, markets are looking to the Fed this week, later on Wednesday and Thursday, I think it is. They're going to be telling us, or we hope that they're going to be telling us about their reduction of their balance sheet. So my question to you is, whether they do or not, what would the mechanics be of them reducing their balance sheet, and how would it ultimately affect emerging market currencies like the rand?
Yeah, so not easy questions this morning. It's quite a complex concept, but essentially what happened after 2008 financial crisis, you saw the Fed, going into the open market and buying assets. So they bought mortgage-backed securities, they bought US Treasuries as well, and that really, when you look at a central bank, they can just buy indefinitely because they control the money supply, and they essentially allowed their balance sheet to swell to, I think it was about 4.5 trillion at the moment. You remember it was I think it was May 2013, you saw the taper tantrum, and that was when they stopped the QE programs, which was that asset purchase program. And you suddenly saw the markets get very panicky about what would happen when the Fed wasn't supporting things. Now why were they buying these treasuries? It was one, to enhance financial stability, but it was also to try and bring rates down to artificially low levels. So obviously when you buy a treasury bill or you buy a bond, your coupon remains the same, so it forces interest rates lower. So essentially it's a very accommodative monetary policy. Now what happens is, there's a lot of concern about, leaving the balance sheet at this size, and how they're going to unwind it. So there's essentially two ways they can unwind it. They can sell off the securities that they have. This is a very aggressive way of unwinding it, and obviously you see the reverse mechanism in play. So you're going to see basically natural market interest rates starting to increase. Now, you ask how that will affect South Africa. With developed market rates going up, you'll see money flowing out of emerging markets, as it can get higher yields in the developed world. The second way is they can just allow the balance sheet to run off. These are maturing securities, so if a lot of the debt that they've bought will mature within 5 years anyway. So that seems like the likely approach that they'll take, that they'll allow the securities to just mature, and then they won't reinvest in them to maintain that balance sheet size.
Okay. And then now with the euro, we see that it's been firming, this in anticipation of tighter monetary policy coming from the ECB. Now, the ECB hasn't started monetary tightening yet, but the market believes it will. And on top of that, Mario Draghi didn't say anything to give the market the impression that the euro shouldn't be as firm as it is. Your thoughts?
Last week Mario Draghi came out and he said that you can see that the reflation has begun in the eurozone. I think what he was trying to say to the market at that stage was that we're starting to see growth, those green shoots of recovery starting in Europe, and the market can always interpret these things when a central bank says that in two ways. They can either believe the central bank and say, yes, there is growth in the eurozone, this is a very positive thing, or they can say, ooh, the central bank thinks that there's growth, that means that we're going to have tighter monetary policy, that we're going to see a more aggressive tightening. That will then obviously strengthen the euro, but it's also fairly negative for stocks because you expect a more hawkish central bank. So the way that the market interpreted it was certainly that Mario Draghi probably wasn't correct, that there was wasn't growth, but that we were going to have tighter monetary policy in the Eurozone. And that's, as you say, that's saw the euro get a lot stronger and stocks, perhaps not perform quite as well as they could have.
Okay, cool. And then OPEC meets today with some of its non-OPEC partners to discuss oil output and price. One of the people or one of the countries they'll be looking to encourage to cut output is Nigeria. Now, Nigeria has been in recession for over a year. How are they going to be able to negotiate that with them, given that that country probably needs all the revenue it can get?
Yeah, it's certainly going to be a very tough negotiation, but I believe that Nigeria has now actually, said that they will cut output, and we've seen the oil price starting to recover on the back of that. Now, I'd imagine Saudi Arabia has gone in, really as the leader here. It's, the major oil producer in the group, and it has cut production significantly. And, leading into the meeting, they were saying they were going to take very forceful tactics, and I suppose the downside would be if Saudi Arabia decided just to, open the taps and pump and not try and address the supply deficit that, or at least the oversupply that we have in the oil market at the moment, you'll see oil prices collapsing back to that $30 level barrel. Now, how would that affect an economy like Nigeria, an economy like Libya? It would put them, even further into recession and be incredibly dangerous. And it's really, I suppose, the negotiation would be around how do they work together to just try and address the supply-demand issues.
Okay, more questions, but not enough time apparently. Well, unfortunately, we don't have much more time to speak with Gary. That was Gary Booysen. He's from RAND.